I need some traction.
Hey, Traction fam, our speaker today is a software industry veteran with 3 CRM startups under his belt, including 1 IPO. At Practical Founders, he's an advisor to 40 practical SaaS founders all over the world. He hosts the weekly Practical Founders podcast, interviewing successful founders who grew valuable software companies without big funding. He also publishes the Greg's List, his curated and up-to-date list of local software companies in Phoenix, Dallas, Toronto, and other cities outside Silicon Valley. He's a top voice on LinkedIn and an ace community builder. The man, the myth, the legend, Greg Head. Thank you for joining us today.
Hey, Lloyd, I guess I'm a legend in your own mind. Thanks for that intro.
You are a legend, my man, because in a world that's been perpetuated by unicorn porn, and it's a graveyard today, in a world where the media has perpetuated this addiction to unicorn porn, in reality, the world is run by horses, camels, and donkeys, and you are one of the rare people who champions the horses, camels, and donkeys. For me, you are the ultimate legend, my man.
Oh, thank you. Well, it's interesting because I came out of the VC-funded land. I've been growing software companies, not just startups, global scale for 30 years. So I've been doing this a long time. And the 2 biggest ones were venture-funded growth companies to 100 million each in revenues. And I'm converted now. There's a place for VC-funded startups, of course, but it's just been overprescribed and misunderstood by founders. And I'm waving my hands out there for my founder friends. Say, don't take the drugs unless you know what the side effects and the obligations are of, the big VC funding, the Series A, B, C, funding that everybody's clapping about, but it's totally misunderstood out there these days.
A very similar analogy comes to mind, right? Don't take steroids if you're not going to go compete in Mr. Olympia. If you just want to go to the gym and get fit, you're okay eating clean and dieting and doing the basic stuff.
Eating clean. So I joke that, nobody evangelizes like the converted, right? So, I didn't come out of bootstrapped land and say, I worked for me that one time and here's how you should do it. I've done it all kinds of different ways. There's all kinds of different ways to do it. I'm not religious about it. There's a place for VC funded and even big VC funding. And you can't argue that. And there's a place for bootstrapping and the 17 flavors in between. But what works for the founders? The difference is I'm not selling funding. I'm actually just out there helping serious founders. So, kind of win their thing their way, like you did. You were on my Practical Founders podcast. I call them Practical Founders, who are growing valuable software companies without big funding. And you're one of them. And you shared your story. And everybody's got a different way to do it. There's a whole bunch of ways to do it. And it's way better for serious SaaS, most serious SaaS founders. You have to be the exception of the exceptions to win the VC-funded growth game on the founders' terms. So it's possible, but we just hear about the few that the unicorn porn, like you say, the few that won. They're always on stage at SaaStr, and the clapping and so forth. And the whole ecosystem, the funding industrial complex from TechCrunch to every ecosystem is built around the funding. They're selling something. So I think it's like it's kind of an opioid crisis, or it was in 2020 and 2021, when people were just lining up and taking the drugs. And it's kind of life-changing if you didn't choose very wisely. Another analogy is in the States here, we have a lot of young people take student debt to get into college, which is very expensive. So it's a little bit like the 17-year-old smart kids taking out $1 million student loans that they have to pay back the rest of their life and trying to get into the big Ivy League school. Well, there's a place for that, but most aren't going to win that game. And if they really knew what they were getting into 10 years later, they probably wouldn't have done it. So, and the game is changing for Practical Founders. I'm sure we'll get into it, but I'm talking to over 500 founders a year and investors, just the same. I invest in companies. I still play that game. I know a lot of VCs. So it's, and the funny thing, Lloyd, is I'm out there kind of sharing some truths for founders, and I'm trying to make it as clear as possible. And I kind of have a huge following on LinkedIn. But my stuff is irrefutable. It's just another way to do it. You can't argue with it. And VCs aren't arguing with me. In fact, they kind of appreciate it, but they just don't say, it's a little bit like taking your nutritional advice from McDonald's. Of course, I'd supersize it, they'd say. And it's probably not the best thing. So I'm just one of those friendly, helpful people, kind of telling it like it is. And I'm tracking this game. The game is changing for practical founders out there. And it's way easier to create a software company and get it to value and make life-changing wealth and create the impact you want in the world than it was 20 years ago. So you don't need the VC funding in the same way.
Definitely. I completely agree. Now, from when you were building these companies to 100 million ARR, and in the last 12 years on my entrepreneurial journey, before I started Boast, I only worked for venture-backed companies. And every one of them
How'd that work out?
Failed. Every one of them failed. The only success I ever had was a bootstrap company, but it was also because it wasn't like when we started the company, people were throwing money at it. It was a small niche that we targeted, and we bet on that niche that it's going to explode someday, the startup market, in a small service for that niche that we also bet that's going to explode someday. And those are not interesting for VCs. Now, one thing I want the audience to be clear, this session is not meant to be bashing the VCs. There's more than one way to build a successful company.
Yes, of course.
And I think the problem much lies in the ecosystem as a whole. The VC math is pretty clear. You and I are investors, okay? We angel invest. We're LPs in funds. We invest in venture capital funds because we want an outsized return. Now, there are bigger fish than us who are endowment funds and institutional investors. They invest in VC funds for outsized returns. If the VC can't generate outsized returns, we're putting the money in the S&P 500 on the index fund. The S&P is up 17% this year. Why put it in a VC? So the VC is forced to find companies that triple, double, outsized returns.
Yeah,
exactly. Or else they're not going to be able to raise the next fund and the next fund. Now, here's the thing, though. I think the vast majority of the accelerators, incubators, advisors out there, they come to startups saying, especially at the early stages, you got to polish the pitch to make this seem like a massive market to win the deal. Everything is so focused on winning the deal from the VC, but you never ask the founder, is this a journey that you want to go into? Do you know what the next 10 years of your life is going to look at? Because winning the deal is literally a foot in the door from the grand scheme of things. Once you go on that journey after you raise the money, you got to basically sign up. You're signing up for the triple, double.
Yeah.
You can't do that if you're not mentally aligned with that. You think the win is the TechCrunch article that says founder raises X million from YVC. But really, the journey is what happens with that money. And so if you've not braced yourself, then there's going to be misalignment that's going to create problems. But I want to dive in, right?
Yeah.
When you were part of the VC-backed companies 20 years ago to what's happened in the last 2 years is very different. What did the VC landscape look like and route to getting to 100 million ARR back then? Like, what was considered a decent amount of money to raise, and what were the metrics, and how does that compare to what happened in the last 2 years?
Well, I've been doing this for 30 years. So there was the early 90s of VC, the late 90s of VC, the 2000s of VC, the beginning of SaaS, mobile, social, after the iPhone and broadband, and then there's the 2015 SaaS, run up. There's 2020, so there's all kinds of shifts. So it's been changing all along. Generally, as you described, the math hasn't changed for VCs. It's literally in their documents. Nobody's confused about it in their world. We talk to 1,000 companies. We invest in 5. Maybe one of them will be big. 1 out of 10 has to literally make the fund be a blockbuster, and 5 out of 10 are not going to do anything. It's always kind of been like that. But funds have gotten bigger. Their fees have gotten bigger. They take their 2% fees every year. But if funds used to be smaller, they would make Series A bets of 2 million. And then 2 VCs would jump in on a Series A for an early company that had a little traction and, raise 5 million Series A from 2.5 VCs. It was just smaller bets. So the biggest thing about the fund size to the smaller bets that they can make in the old days, and now bigger funds to bigger bets, is the funds can only win, which means the founders can only win if the exits are stratospheric, half a million or half a billion to a billion, or now decacorn, right? So that's really kind of crazy because there's still just hundreds of companies that have ever been worth software companies that have ever been worth $1 billion. So everybody, all the VCs are still trying to find those 100 or 200 companies, or less than 1,000 that are going to last and be worth that much. But they're investing in tens of thousands. So the game has changed for the VCs. There's bigger funds and bigger investments. On the other side, startups didn't used to be normal. It was a crazy freaking adventure back then for crazy people who were doing crazy things and building new categories and products and so forth. So we knew it wasn't normal. And we knew what the professional VC funding game was. We weren't surprised that there's liquidation preferences and board seats. And, we had to be very aligned about those things in the old days. Now there's a lot less alignment between the expectations and the understanding of founders and VCs. So, because it's just kind of cool to be a startup and everybody does it. That's kind of the myth. Everybody does it these days. But in fact, most outside Silicon Valley, fewer than 20% of software companies take institutional capital. So, but last thing on this, TechCrunch yesterday said there was an article about bootstrapping on TechCrunch, the ultimate VC funding, hand waving, clapping website, and which I read. It's really interesting. But there's a bootstrapping article yesterday, and it starts by saying some founders have to bootstrap, and it's becoming more popular because they can't raise VC funding, and they're disadvantaged, and they literally use those kind of words. And the reality is the world has changed. There's so many software companies out there that are growing and creating valuable companies that never considered VC funding. They got up and running, got over the valley of death to customer funding and revenue funding without VC funding, and it's a better way to do it. So for most founders.
So there's some truth to that, right? When we started Boast, it's not like people were coming to us in droves to raise, but we weren't also looking because we had this PTSD from seeing VC-backed failures and only being a part of failures. There's more than one way to build a successful company, but here's the drill, okay? Let's follow the journey of a VC-backed founder.
Mm-hmm.
The odds are not the best if you want to make a boatload of cash, because think about it. Let's say you raise a seed round at a 10 million valuation. Now, at the bottom of the barrel, a VC wants to make at least 3x on their last round of valuation, right? At least 3x, infinitely higher if they had their way, 100x. But at the very minimum, they want to walk away with a 3x valuation. 30 million, you can sell the company if your last round was 10.
Yeah.
If your last round, let's say you do the A at 40, 50, you may be able to sell it for 150. Now, as soon as you start your Series B at 100 million valuation, how many deals are happening at a 300 million valuation? We don't see them a lot. Right. And once you raise at a 300 million valuation, you're signing up for an IPO. How many of those are happening? We only see the anomalies in the media, right? This exit, this acquisition. Yes, it's great to aspire to the anomalies, but that is just an anomaly. The 99% of the people don't land that way. And see what happened in the last 2 years, right? There's a black swan event. Everybody needed to digitally transform. Startups saw obscene amount of growth. Interest rates fell. So all kinds of funds started flocking to the market, tripping over each other to invest at sky-high valuations. As soon as the black swan event ended, nobody needed to digitally transform. Projections went down, interest rates went up, and so many unicorns are not even talking about their valuation anymore. They can't grow. They can't raise. If they raise, they wipe out their whole cap table. They're stuck. There's a graveyard. There is a graveyard. So your journey is very, very impressive to us because I think, for most founders, when I talk to, I say, hey, think about what kind of journey you're signing up for. Like, is there a personal definition of success you have? I know a lot of people don't like asking this question because they see themselves as, oh, you know what? I'm going to be seen as short-sighted and not having a big vision. But you're on this journey to do something, right? For a reason. Right. Like, I understand you want to create impact, but ultimately, why are you on this journey? You want to live a life of joy at some point. What does that look like? not money, but what is your personal definition of success? That might be farming in Bali or bumming on the beach in Costa Rica. And then figure out, like, if I wanted to fund that lifestyle for the rest of my life, how much money I need in my bank account. And the last one is on values. Is there a version of this company that I don't want to work for? Because a lot of the times what happens is you bring on partners in the company and their values don't align with you, and you may not want to work according to how they want you to operate. And so you're out. But when you don't align on those values, then you go down this path. But was there something like that that inspired your journey to becoming a champion for practical founders?
Well, in the old days, we were all very aligned. We knew what the game was on both sides of the table, and we were playing this game together. I'd say VCs were more practical, and we were more realistic about what the milestones and what the game was. And 20 years ago, there was a lot of open markets. So if you were fast and savvy, you could create a category leader, which I've been there before. So it's a little harder to do that now. It's a little more risk on both sides there. So, but my inspiration was after growing a second company to 100 million and, handing it off to people who like that phase of growth and going back to startup land, I started helping all my friends in Phoenix, where I was living at the time, and all over the place in their growth game. I've been growing companies and I went helping them. And I started, some were funded and some were not funded. And in 2017, 18 or whatever, this, SaaS was moving fast. And I started between my Craigslist.com. I track all the software companies in Phoenix and Dallas and Toronto. Toronto's very popular as well. I could see that the VC funded founders on one side and the bootstrap founders and ones who had practical funding were staying off the big funding drugs. I literally did a longevity study with thousands of founders, and I could see more and more VC funded software founders growing up and getting stuck, kind of being in jail, which is no fun. Those layoffs, those I can't raise, those my board wants to replace me as a CEO because I'm not making the milestone and keeping up. If you don't keep up, it's no fun. It's really exciting when everything's, going to the moon, but it's really brutal in a VC-backed company, as it is right now in Silicon Valley. The mood is not very good in Silicon Valley. It's really brutal there. So I'm watching that, and I've been part of that, where it's no fun getting stuck in a VC-funded company. And I'm watching my bootstrap friends that we used to pat on the head and say, sorry, you can't raise funding in the ecosystem, grow these steady companies. Then 10, 20, 30, 40 founders in Phoenix were growing serious companies. They had fun along the way. Many of them took profits along the way. They had amazing cultures, happy customers, growing revenues. They did it their way. They didn't kill themselves toiling in the VC-funded, mega growth bet. And then they would sell them for life-changing exits. So I know 40 people, friends of mine in Phoenix, that I watched sell their companies for 25 to 150 million without investors on their cap table. And now they're the wealthiest founders in Phoenix who do the most angel investing, ironically. So I started seeing this at the same time. And, I've helped a lot of people get VC funded, and I played that game. I've raised over $150 million and spent years of my life in Silicon Valley raising money and doing all that stuff. But the game changed. And now I advise founders to stay off it as long as possible. And for most founders, just don't even go there. You're going to waste a year of life trying to raise funding, and you might as well just go build a product and sell it and get going. So it's been a slow conversion, but I just totally see what's going on. The cost of making software now is 10 times cheaper than it was 5 years ago, and more than that from 10 years ago. You don't need VC funding to build a sellable product and get into market and get your revenues going. You used to need VC funding to build your first version of the product. You used to need VC funding, round 2, Series B, to do the growth game, to do the advertising, build out your big, expensive sales force and all the rest of it. You don't need to do that in most cases to get up to $1 million or 2 or 3 million in ARR. Also, there's a very active market for buying software companies. And you participated in this. There's all kinds of flavors of this, but recurring revenue, we didn't say ARR before 10 years ago, 12 years ago. We just said revenue. It wasn't recurring. Recurring revenue in the sophisticated SaaS engine is an asset. It's a flywheel that investors are buying companies at 1 million ARR, 3 million ARR, 10 million ARR, and for life-changing exits with strategic multiples. It's really exciting. So those things didn't exist in the same way 5 or 10 years ago. And so the world has changed. And I just have been chronicling it and saying, here's what's going on. On my Practical Founders podcast, I've interviewed 50 SaaS founders, including yourself, over the last year. And the average exit value for the founders is 40 to 50 million that goes to the founders. And, between some sell it for 10 or 15 or 20 or 30, some sell it for 100, 150. I've had them all on the podcast. In order to make 100 million for founders in the VC-backed Series A, B, C, D, E funding rounds with all the dilution and so forth, you literally need to sell your company, be one of the few software companies ever to sell their companies for billions of dollars to make that kind of prize money at the end. So I think the equation's just better. There's certainly VC funded companies that need to be VC funded. There's explosions and it's a growth game, the whole AI platform game and so forth. But for the most part, most software, vertical software, niche software, platform software that isn't trying to be for millions of users immediately, you can get that going without. And I'm a serious grower, so I know what it takes to grow these businesses, and it's more efficient and better health overall to do it without big funding as long as you can.
Definitely. The world has changed. Technology, no code, low code AI enables
AI's coming. It's making it cheaper. AWS, these platforms, Twilio, SendGrid, everything. You used to have to build all of that yourself.
You don't need to.
You don't need code. Yes, right. Yeah.
And
so
even
really
like
amazing.
Even our journey at Boast, right? We went and got 10, 20, 30 customers to pay us. We delivered the service manually. Then we figure out where we were spending lots of human capital. If you need to collect the data from them, you build APIs. Then you build technology.
APIs, yes. Right.
You write code to normalize the data, and then you write code to workflow it. Our first version of the software, when we were million or so in revenue, was Zoho Creator with Zapier. Right now, there's Bubble and much easier
behind
solutions.
People who were doing the services. Yeah. Mm-hmm.
Yeah. And so first it was people, then it was Zoho Creator with Zapier, then maybe millions in revenue, and we moved to a full-scale platform. But man, the harder thing to get is an audience. Whether you're venture-backed, a bootstrapped, or any kind of founder, getting an audience, customers, is harder than building technology. So why not go down this route of figure out the ideal customer profile? What are their pains? What are their aspirations? Can you get 5, 10 people who are not your cousins or relatives to pay you to try it out, and then deliver the service manually?
Yeah.
If you just forget the whole fundraising path, if you just do those 4 steps, meaning validate with paying customers, deliver the service manually, and then build an MVP with no code, low code, plus AI, plus like some APIs, if you can just stretch that far to 1 million ARR, you'll already have more control of your company and more autonomy, and you can raise on your own terms. Don't even have to take it all the way. And
here's the irony is that VCs, this Silicon Valley Series A, the big funds and, trying to put in big checks, and the little guys out here outside of Silicon Valley, all over the US and Canada and Europe and the rest, the little smaller investors, they're waiting for you to get the recurring revenue flywheel going with paying customers who like your product, that you prove how to sell. Almost nobody's getting funded with, I have this idea of these kind of people that should buy. There's some very smart people raising money on decks in the AI world right now, but almost no investor in outside of Silicon Valley is funding first-time founders because of an idea. I got an idea and then I get funding. What a myth is that? It's, they're waiting for you to get to 30, 50K MRR in B2B SaaS land. And I focus on B2B SaaS. There's a consumer software world over there, and there's there's deep fintech, in another side, and there's all kinds of other startups that could get funded, and consumer products or whatever, climate tech and all of that. But I'm a software guy.
Definitely. Awesome. So let's dive in a little bit more into Bootstrap versus VC. We talked about the many reasons why you can have control of your company or have more ownership in your company. And honestly, in many cases, selling a company that you own 100% for 100 million, right? The odds of which are much higher, selling for 50 to 100 million, odds of which are much higher, and you own 100% of that. Do the math here. Let's say for the average company, by the time you hit a Series C, each founder, three founders, each founder owns 10%. And now at Series C, you have to have a minimum 300 million exit, right? And so you have 90 million now, right? To split between three founders. You end up the same if you had $100 million exit and you were largely bootstrapped, right?
Yeah. So that's, people don't see this. So this is the obvious truth. It's irrefutable that the average founders and employees own less than 20% of their company when they IPO, these big tech software IPOs, right? Of which we just had two in the last week here in September, the first in 18 months. So there was 0 IPOs in the US over that time. And there was a lot before that. But the average IPO through the last 10 years, founders own 15%. In some cases, they can own 50%, but that's pretty rare. But most of them have done the Series A, B, C, D, and every time it takes 20% out of the chunk. And pretty soon, if you've raised enough funding, you don't have much left for founders. So that's just a simple math, and that's one way to think about the bootstrap versus VC funding. But for most founders, Lloyd, that I've talked to, CEOs have sold their companies and people playing the game and getting up and running and successful, they understand the math. But the bigger reason that they're staying off the funding drugs is they're savvy. They're smart. They're hardworking. They get it. They know deeply. They actually have to be better at SaaS metrics and product market fit and go to market and CAC to LTV than a VC funded founder who can splash cash at it and kind of paper it over there. They're very savvy. They know they can get to a valuable company without a lot of funding. And they're extremely disciplined about how they do it. But the bigger thing is they don't want a board. They don't want silly people telling them what to do. They don't want to go faster than their market, their team, their product fit, market fit will allow. Getting through product market fit and then building go-to-market motions, these don't happen instantly. And VCs have a lot of expectations that, yes, that needs to happen instantly, and then we're going to move forward and it's going to keep moving. They want to control their own pace. They want to control their culture. They want to maintain their independence and their optionality to raise VC funding later if they want, to run it forever if they want, to sell a piece of it if they want, to sell it outright if they want. And they literally, that's more important to most of these successful SaaS founders that on the Practical Founder podcast and otherwise is just they've bought their independence and they don't want to give it up. Any software founder who's built a 2, 3, 5 million ARR software business, did it the hard way. And, the business is growing and, every software business is a little imperfect, but if it's in pretty good shape and it's growing, they're getting offers to get funding and buy the company like constantly. There's, thousands of investors and people that want to buy it because this recurring revenue is an asset. So anybody who's got a 3 to 5 million, more than a 3 to 5 million ARR software business anywhere is getting offers to buy it. And they're saying, no. It's not because they're doing the math. Sometimes it's, you haven't hit my number yet, but it's, they love their independence. They bought their independence. It's awesome to run a company and make all the decisions without having to ask for permission from your number one customer, the VC investor. That's what happens. So it's just pretty amazing. And there's so many healthy habits about marketing, about customer service, about employees, about culture, about product design that are coming about in these practically funded software companies. It's really amazing. And I love seeing happy founders and happy customers and happy employees in a growing software company with total independence. And they can do the right thing without having to play somebody else's game. The old joke is, or the old story, it's true, is you inherit the business model of your biggest investor. If you raise 20 million from a big VC fund, there's simple math of that fund, and that is your game, or you will get fired. That's your first game. So they become your customer. And it's just amazing to see all the different ways that bootstrappers and practical founders all over the world, not just here in the US or Canada, in Europe and Latin America, in Asia, India, that they're all doing it different ways that work for them. It's just really amazing.
Fantastic. Fantastic. Now, there is, though, scenarios where people should absolutely go and raise venture capital.
Yeah.
What are those scenarios in my mind? In your mind, sorry.
Yeah. If you know the math that, on this big venture capital, they have institutional funds, they have investors who invest in those funds, and the whole Silicon Valley game. But if you understand what their math is, and you say, I really am confident that I can build a company that will grow to 100 million. I see it kind of clearly, not like, hey, that's what we do, I'm confident. No, like if you can see that pretty clearly, not every market you can grow in 5 to 7 years after starting the business to, head towards $100 million company. That's the time frame. And that's a 10x on 100 million, $1 billion company. You got to be able to see that you can get there, and you got to bet your company and the next 10 years of your life that you can do it, or you shouldn't take the VC funding. So there are some games that are like that. And I played that game and grown. I helped start a company in the mid 90s. At the beginning of CRM, it was called Sales Automation. At the end of it, CRM. We went from kitchen table starting it in 96 to being public in 99 and selling it in 2001 from 0 to 100 million and 500 employees in 5 years. Okay. That's a rocket ride. Unless you are ready for that rocket ride and say, I want to do that, I like that, that would be fun, I'm all in, then, don't play the game. And so that's the big deal. The real thing is, if you make that bet and you raise that money and your company doesn't grow and something happens in the market and you're not the guy to run a 1,000-person employee company, it's really no fun for the founders and most of the employees. You kind of get stuck along the way. The majority of VC-funded companies get stuck along the way, and it's kind of no fun. So, and I've done both. I've won the big VC game big time once with an IPO, and I was one of the co-founders, and also, grown another company to 100 million that hasn't sold yet. So all that VC funding is still stuck, and it's not as fun when you don't sell a company after all those years. So, yeah, you got to be thinking big and know you're that kind of game. The bigger thing is, I ask founders, like, do you understand what this game is? And most founders don't understand what the expectations are and what the reality is. So it's totally possible. If I can do it, then other people could do it. I'm not saying it's impossible, right? You got to be a stellar person, but the odds are against you, and you got to understand what the game is.
Definitely. Now, let's dive in then. One, what is the path for practical founders who don't raise big funding? You had 7 paths. You have this great book coming out.
Yeah.
7 paths for practical founders to win big, right? What are the success paths? So let's dive right into that.
Yeah. The first path is you got to know which door you're going into, the big VC funding door or this bootstrap / practical funding door. Practical funding might be angels and, friends and family and a little debt and other kind of creative things, but isn't the big VC funding game. And if you choose not to take the big VC funding or don't want to play that game, you're in the practical funding, practical founder zone, as I call it. And within there's not just one way to win, like there's with VC funded companies. Either you got to sell it to a strategic or go public for $1 billion, or it's going to be really painful. There's a whole bunch of ways to win, which is also really exciting. So founders can kind of choose when they have optionality, and they do, to run their businesses and succeed in different ways. So I just am publishing an ebook this week, a 60-page ebook. I've had this conversation 1,000 times. I've talked to groups about it. I do therapy with my peer group founders every week about what their game is. And I have 40 CEOs in my peer group, practical founder peer groups, and I advise founders as well. So I'm having this conversation constantly on the podcast as well. There's 7 ways that founders are winning in the end. And I had you on the podcast, and you were one of these in one of the swim lanes. The first thing is to build a long-term profitable company. So you were building a company. You weren't thinking about funding, Lloyd. It was profitable or pretty close, sustainable at any rate. And you could have run it for a while and done it bigger. So that's kind of the default state. Some founders out there, just like Jason Fried, who you've had on this podcast, are advocating just, why wouldn't you run it forever? Why wouldn't you create this 5, 10, 20, $50 million, very profitable company where you have total control and do all the magical things? I see that. I just talked to one of the founders in my groups this morning about that. It's so amazing what they are doing if they don't have to sell it, and they are having the time of their life, and they're saying, this is so much fun. Why would I sell it? That kind of thing. So the first one is long-term profitable, which is kind of the default state. If you want to sell it to a strategic buyer, the second success path, or sell it to a financial buyer, the third success path, you actually have to be able to tell them, no, I'm good. I don't have to sell my company right now. Come back when you want to pay a higher price and buy it on my terms, right? So one of the paths is to sell to a strategic buyer. This is the one that where you get the biggest multiples. Big company buys your little company because they really need it. They need you more than you need them. And like Instagram was bought for $1 billion, 15-person company bought for $1 billion by Mark Zuckerberg, but it was strategic. He bought it, and everybody said that's price is crazy, but now it's a $50 billion business, and so it was worth it. It was a good investment, so it was worth more to them. So that's strategic buyers, and I would say if founders are thinking about selling their companies, and like the founders I talked about, the ones who pay the higher price are the strategic buyers. And it's a good home for their business. They're in the same industry. They have way more customers than you do, selling your little thing to their customers, and they can sell it, and they can make it a much bigger. It's a much better business inside their business than outside. And one of the things that they changed in the last 10 years is we have a lot more financial buyers, and these are private equity funds, growth equity funds, roll-ups, entrepreneurs that go get debt to go buy your little software company. They're buying it without big strategic reasons, and they're more concerned about profits and growth, and they're more frugal. So the multiples, when you sell to a financial buyer, less synergies in their business. They know your industry a little less well, but they're buying it more for your revenues and your profits and things like that. More like traditional businesses are bought and so forth. So financial buyers. So strategic buyers and financial buyers are usually the 2 biggest exit doors for practical founders when they get their 3x multiple of revenue, 5x multiple of revenue from financial buyers, 7x from strategic buyers, 10x. And when markets explode, 20x, 50x, those kind of things that happen. So, but it's surprising how many software companies out there are just steadily running it with no intention of funding and selling. And here's the magic trick for founders. If you get your business to 3 million ARR and people are trying to buy you for 5 times revenue, if you triple the business to 10 million ARR, 5-time revenue is a lot, it's not 15 million exit, it's a $50 million exit. So just keep that flywheel moving, keep the growth game going. So that's another reason to have your optionality, not have to sell, keep doing it. Those are the 3 biggest ones. I could go into more of the other ones, but that's my little stump speech for what we're seeing out there. And on the Practical Founder podcast, all of those founders exist, and they're just everybody's winning in their own way, right? They found a way to work for them.
I like this. These 3 ones, was right. Long-term profitable growth, exit to a strategic buyer, but exit to a financial buyer is very interesting, right? So what's happening right now is the markets are like Klaviyo had probably the best IPO, right?
Oh my gosh!
But what was the multiple there? 12x, right? Wasn't
well, I don't know exactly what it was, but they had a successful IPO last week. But it was at the last valuation for the VCs, who put in hundreds of millions of dollars and didn't make any upside profit on it. They just got to get their money back.
But nonetheless, Very interesting. And so that's what I'm pointing out is the markets have corrected, and the best in class, best cream of the crop in class company like Klaviyo is at 12x. So what do you think your VC-backed company is worth if it's not best in class like Klaviyo? 6 to 8x, right? And so what's happening right now is a lot of public companies are 6 to 8x, and a lot of PE firms out there, as the market for IPO is heating up with the Klaviyos and that happening, they're looking at companies with good revenues to just buy revenue because it's cheaper to buy 30 to 50 million in revenue. Right? So this will happen a lot more. Like a financial buyer will buy your revenue as long as there's some sort of synergy selling to the same customer or whatever. They'll buy your revenue because it's easier to buy 30 to 50 million in revenue than to go acquire it in the short term and give you even like a 1x more leverage on the IPO market, right? And so you'll see that happening. You'll see a lot of PE firms in the next year, because I'm getting hit up a lot as well for both. I'm not even in the day-to-day, but that I was the last contact, is trying to combine a few companies in the same synergistic industry.
Yeah, it's the roll-ups and to cram them together and put debt on it. You know, that didn't happen in the old days of software. It was the normal MBAs and the leverage buyout guys, didn't play this kind of crafty game. But the SaaS flywheel is so virtuous. And once you get it going, it's kind of hard to kill. And they know they can do it more efficiently than the scrappy founder, get more profits out and so forth. There's another magic trick in there is, say, a $5 million ARR software company, maybe they're getting offers at 5x. On average, something like that. If you grow it to 20 million, you're going to get a multiple kicker. It's going to be 7x because you're a bigger company. It's less risky, all of that. So that's part of what the private equity guys do is they know that you're going to grow revenues and you're going to get a higher multiple just because you're bigger. So there's a math game going on in there. Most of the inbound tire kicking stuff that founders get who have up and running software companies, hey, you want to talk about buying, selling your company and all that, is from the financial buyers who are trying to, let's say, bottom feed and trying to find a deal and, give you a lowball offer and those kind of things. So when strategic call, you take the call. If Microsoft says we're interested in buying you because there's something we see in you, like, yes, that's different than a private equity firm who's looking at your financials as the main front door to your business.
Definitely. Now, I like some of the other things there you had in your book. One is profitable lifestyle business. The VC world will make you feel like crap for having a lifestyle business. But hey, if you're cashing out a couple $1,000,000, you and your co-founders, that's a lifestyle every year. Exactly. That's a lifestyle that most people won't be able to touch until they exit their company. So think about this, right? Your exit is locked for 10, 15 years in most cases. So think about, unless you get lucky. And so you can't assume you're going to win the lottery. You have to assume that this is going to be a long slog. but the funny thing is we're so attached to this. Oh, let's grow it bigger. Let's grow it bigger. And this ties in part to the American or the Western dream is your life is designed to run around, to live, to work, retire at 65. So now you go from the tax system to the hospital system. And when you retire at 65, average life expectancy is 78. So you have 12 years, 11 years to live, and you're not functional in that time. So all your life, you sacrificed the things that brought you joy to run the business, to work, to drop pick kids, to pay taxes, mortgage, all of that stuff. You ran around. Maybe you had one social activity a weekend. Sundays went planning for the next week. Maybe you had a 2-3 week vacation a year, but half the time during that vacation, you're on your laptop, you're on your phone. And then you hit 65. Maybe before that, maybe at 60, 55, you had some outcome. And now you're going to go on this journey and you're not functional. Hey, design the life you want to live. And if cashing out 1-2 million a year between co-founders is a lifestyle business, hey, I'm taking that lifestyle all day long to spend time on my kids, to work out and to have fun and to travel the world. Life is too short, man, to build somebody else's definition of success. So talk to me about that.
Well, that's one of the flavors. And by the way, I would have a hard time doing that. And Lloyd, maybe you would too. That, hey, I would work a couple days a week and then I would hang with my kids and coach the soccer team and travel and do exciting things, right? I like to work and build and grow and do all that stuff. And that's why I succeeded in the VC funded growth game. But the profitable lifestyle business now, I mean, VCs have always said, unless you take our funding, if you don't want our funding, then obviously you must be a lifestyle business. And how stupid is that, right? But here's the deal. There are a lot of founders out there that have built 3 million, 5 million, 10 million ARR software companies that grow a little bit every year, and that they spend a lot of money. They've tried to grow them faster. It won't grow any faster. And they try to sell it to strategic and they can't get their number. Then they try to sell to a financial and they can't get their number. And they say, well, you know what? This thing is running and I like working on this, but I'm not going to push as hard. I'm going to take Fridays off, then Thursdays also off. And then I'm going to start pulling some profits out of the business. That's usually where they end up. Not every founder likes that, right? To be a part-time CEO. And this is one of the flavors. But like Josh Strebel, who sold Pagely, friend of mine in Arizona, to GoDaddy, he grew this thing up, bootstrapped, and then like the long-term profitable, he was growing as fast as possible, and then realized there was kind of a ceiling in his market, and whatever they pushed on didn't do it. So he started to pull back and, take profits out of the business, live an amazing life. There's Josh in Japan skiing in the powder, and there's Josh doing this. The company kept growing, and eventually he sold it to a strategic for a strategic valuation. So he did a 2 bytes exit, he took money off the table for years and had a life along the way. Like he literally won the prize as he was running the software company. And then he sold it to a good home and made a monstrous prize there. So by the way, those are the people that lived a life while they were growing their companies, who, when they sell their companies, you say, what has your life changed? They say, it didn't change. I already had the car I wanted and the house I wanted and the vacations I wanted and the family I wanted and the time I wanted. I'm just going to do more of that. For you and I, when we stop the all-in game, it's kind of psychotic to imagine sitting on the couch or playing golf or doing something like that. We get back and we do it again. So there's different flavors, different strokes for different people. But can you see not having the obligation to sell your company because you have big investors, and having the independence and the optionality to choose any path? You can kind of change your mind and learn as you go and figure something out and all of that. And there's no right or wrong here. What works for the founder and what works for their business? It's really interesting to see all the variations. You could just win in your own way. And everybody's different. Times are different. Founders are different. Markets are different. It's just really exciting. And it's getting more exciting. It's getting easier to make software. It's getting faster to go to market for practical founders. Funding is still silly over there. There's all these great exits and all these great options over there. AI is coming to make life easier for practical founders because of the trillions going in to make the new AI platforms, just like AWS and everybody else. That benefits the practical founders. No, I can just use a little API and do magic, right? That gets me to product market fit faster. It helps me raise my price. All that magic is multiplying. There are more bootstrappers, practical founders in the world than there are VC-funded founders. And overall, the odds are way better to create the kind of company you want and win the prize that you want for practical founders in most cases, with the exceptions we talked about. And it's just really exciting. So I talk to these take the founders taking profit out of their business and having fun lifestyle business. It's interesting to me. I've never done that thing, but it's really interesting to me. And there's a lot of them. Some of them have the houses in the neighborhoods, the bigger houses above the VC funded founders, and they're just having a ball. It's really amazing to see how their lives are doing. So I'm kind of old, Lloyd. I remember in the old days, like I worked 6-7 days a week for 25 years, just because that was just old school. That's what you did. You grind and you build. And I'm a crazy person like that. But now there's all kinds of options. There's all kinds of ways to do it. And founders get to choose their path. By the way, the ebook is available for free. I'm not selling anything. And they can look at these 7 success paths and look, I give the pluses and minuses of each, and people can kind of try those on, whether you're starting the SaaS game or you're up and running and looking at your options. It's available at practicalfounders.com/success. And you can just download it. And I hope it's helpful. I've had this conversation a million times. And by the way, like 7 isn't a magic number. It's literally all of the founders on the podcast, all the founders I talk to fit in these 7. In 2 years with AI and the world changing, there might be 8 or 9. I don't care. It's up to whatever, what's working. Practical is what works. So
definitely. Now, what's this 2 bytes exit?
Well, the 2 bytes exit, Lloyd, is what you did. It's growing a company. This wasn't very common in the old days. And when the VCs invested in the 90s or the 2000s, or even the early 2010s, founders didn't, they raised $10 million or $5 million or $20 million, some number. Founders didn't get any of that to take a little money off the table to cash out a little bit with secondary, the cash out kind of thing. And you got to be all in. We don't want to give money to the founders, but it's pretty common now, especially in steady SaaS land, especially for bootstrappers in the private equity and growth equity land. This is 2 bytes. And the 2 bytes of the apple are the first byte is what you did, is you grew a company to 10 million ARR, a growth equity fund, which is different than private equity, a growth equity fund. Radian Capital said, we want to buy into this business. And you say, we're not really interested. And they say, well, how about we offer a little secondary shares? You can take some money off the table. You can sell some of your shares. You can take some prize money now. And you can keep owning the rest of your business for a second bite of the apple, because we're going to grow it up and sell it again, or sell it like they're investors, but they're more practical. The growth equity guys are not trying to do this crazy blockbuster game like the Silicon Valley VCs. They're trying to help all of them. And they're the practical, friends of practical founders out there. And you get 2 bites of the apple. Patrick Fingles, who made a contractor construction management software, very successful, bootstrapped it to 10 million ARR, sold a little bit of it. He bought a boat in Baltimore, and his first boat is called First Bite. He named the boat First Bite. And he's still the CEO, and he's growing it. And they're acquiring companies and, getting support to grow faster. Now it's tripled in size in 3 years. And eventually they'll sell the company, IPO, or do something like that, and to a strategic. And then he'll have his second bite of the apple because he still owns a major part of the company. And the second bite, presumably, if you grow it bigger and you do what you say you're going to do, could be bigger. So isn't that interesting? And by the way, he's going to buy a bigger boat, and the bigger boat's going to be called Second Bite. So he said that on the podcast.
Very cool. Very, very, very cool. Now, as we wrap up here, what's one piece of unconventional advice founders ignore but shouldn't?
Well, we talked about the unconventional thing. Everybody says you should raise funding. And I'm here to say it's not everybody, and it's not as common, and you shouldn't listen to the funders in the funding industrial complex to take advice about funding. But a second one here is the advice about the game as you start and as you grow. The sport of startup and creating a company and scaling a company, the game changes. In the beginning, you are running around trying a whole bunch of stuff, seeing what works. Do these people care about this? Is there a problem? You're experimenting, right? The startup experiments that Steve Blank talks about, Lean Startup talks about. And that's a time to explore, like young people do in their careers or with spouses, right? You've got to try a lot of things and do this kind of thing. But the growth game, getting to 1 million ARR, which is generally around product market fit, and then getting to 10 million, it's very counterintuitive, but the reality is you're actually focusing in. You're focusing in just this part of the target market, just this problem, not all the problems, just this solution that you're offering, just this kind of business model. It's very focused. A $10 million ARR software company is way more focused than a $1 million ARR software company. So you go from, I call it the ADD of starting up, try many things for many people and seeing what's going on, to the OCD of laser focus. So most founders don't know that that's the game, that focusing in is a force multiplier as you grow. And by the way, it's what acquirers want. They don't want to, investors, they don't want you to hear you, yes, we could be for any market, do thing. If we got funding, they want to hear you say, if we got the funding or you acquired us, we would double down and we'll focus in. So That's counterintuitive. It's a law of nature, cannot be defied. It's always there. And that focus is the force multiplier, and it's required to create a scalable, valuable software company or any company.
Focus is everything. If you focus on the customer, it lifts the message, your messaging and your conversions, right?
Yeah, absolutely. At least everything gets better with focus if you do it right.
Unless you have infinite amount of money, but it's not practical.
No, that's a myth. It's totally a myth. We can be many things to many people. Starting off is a total myth. Now, everybody looks at Amazon, says we're many things to many people. Amazon is, and so is Walmart or Google or whatever. But look at how they got their first 10 years and probably their 20 years and what is most of their business. And it's dominant. Like Amazon was just books, just online, until they added DVDs and CDs 5 years later. It was just is the magic word. Find your just. You got to experiment to find, I'm just for practical founders and just helping them figure out how to win their game in their way. That's just what I do. That's just what I talk about in the Practical Founders. And when I narrowed in from helping SaaS founders about all kinds of things, about all kinds of SaaS founders, to just like my signal strength went up by 10. I have 2 million people have seen my posts on LinkedIn in the last 90 days. There's a huge crowd out there. And that laser focus, that laser beacon, like I talk to people all over the world in every continent, and they're reading my stuff and they're getting it. It gets them right between the eyes because of that focus. So in the beginning, it's more like just shining a light and trying to see what's going on, make your way out of the dark. You have to do that and get on the field. But in the end, a growth business is very focused, and you have to be very deliberate about expanding your focus, and you don't do that too quickly. So
definitely, when you're in the thick of things, it's always spaghetti on the wall. When you look back,
firefight. Oh my gosh, totally.
When you look back after you found success, when you look back, it seems like a framework. And as I think back, what are the phases that we went through? Is validation, find 5-10 people to pay you to try it out, right? So you're basically trying to nail down the market. The next step is make sure, as a practical founder, so many definitions of product market fit, which is like NPS score and all of this stuff. But as a practical founder, there's only one definition. The customers paid you to try it out. Those customers never leave you. Churn is bad for a practical founder, meaning if I'm not getting paid, I can't eat. So the next
I'll add one more for that, is that they're literally profitable.
Exactly.
The cost to acquire them and their lifetime value is beneficial. And if people really honestly looked at their segments of their customers, their biggest customers are not profitable because you got to put so much attention. Their smallest crappy customers don't stick around. They're not profitable either. So their profit is a beneficial word.
Exactly. And so that was third phase for us. The phase for us was figure out the target market, figure out you're delivering the value to this market. And the third one was figure out the one channel that they'll come from profitably. So you have a very low CAC payback period. For us, it was community. And so almost there was like it was a CAC payback period of nothing, literally. Right?
Well, there's effort in there that doesn't show up on the P&L. So yeah.
Exactly. And so that was effort in there. So when I looked at it, right, up until scale, it was one kind of customer coming through one kind of channel, getting one kind of value. And that takes you very far, but a lot of people don't like to focus. So I like we're ending with the focus.
They don't have a choice. So their focus, if they don't focus, they won't win in the right way. Exactly. Focus does not scale. It's impossible. All right. Yeah. Sorry.
Exactly.
Focus is required to scale 100% of the time.
And one of the most successful venture-backed founders, Peter Thiel, always says this, right?
Yeah.
If you try 100 things and you are mediocre, you're doomed. If you nail one, you can build a big business. Right. And so for all the wisdom out there, focus is always a consistent thing that will lift everything for you, from your conversion to your messaging and everything else.
It's just hard to hear. And I've been there. Like, you're in survival mode. You're trying to make payroll. You're trying to run things. You think it's going to work and making assumptions. But in the end, that's what happens, is you've got to stop doing all the things that aren't awesome and find one thing that's awesome in one channel and take that up. That's how companies get up. Product market fit is by definition focus. You can't be awesome for everybody. Which segment, which problem, which product, which price, which one are you?
Exactly. Now, where can we follow your wisdom?
Well, you can find me on LinkedIn, of course. Then that's where my main crowd is. I'm not that active on Twitter. My stuff is longer form, and I have a big crowd on LinkedIn there. So Greg Head on LinkedIn. You can also see the podcast in your any podcast player, the Practical Founders Podcast, and you can see all of that at practicalfounders.com.
Fantastic. And this book is on practicalfounders.com?
Yeah, if you go to practicalfounders.com/success, you'll be able to download the free ebook that describes all the 7 success paths and the pluses and minuses and what people aren't telling you out there.
Fantastic. Greg, it's been a great pleasure. Not a lot of people talk about the practicality of building a business, and we were all about that today. Keep shining the light, my man, and we will see more founders with better peace of mind, with better lifestyles, happier by going down this path. And of course, if they want to raise money and go down the whole path of big funding, they can, but because they choose to, not because that's the only option.
On their terms. Yeah, makes sense. That is one of the success paths, is to take VC funding later. That happens.
That happens to a lot of companies. I think recently, which one comes to mind? Do you have one that tops off the top of your head?
The big ones are Qualtrics and Atlassian. Those are the classic stories. But literally, if you go to TechCrunch and you search for bootstrappers, it's all the bootstrappers who eventually take funding. So, and there's, they see an opportunity and the math still works for them and they know what the VC funded game is. And that's another way to play it. Founders can win their game and their way. That's the new way.
On your time, in your prime, on your terms. Thank you so much, Greg. Yeah. Have a wonderful rest of the week.
Okay. Thanks, Lloyd.
I need some traction.